what the last person paid to buy a share. So when we look at charts, they at first can be a little bit intimidating, but I promise you that if you take 10 seconds, maybe a little bit more, to apply yourself to the chart and consider what the components of it are, you'll find that it makes incredible sense. The biggest number right here, and the first one that draws our attention, is this $317.39. That is that last price that one of these Microsoft securities was sold at. And what it tells you is about what, if you were to make a market order right now, you'd be paying for that. These numbers to the right just tell you what sort of progress the stock has made. This is currently set to a year, so it tells you that the stock has increased in its value at 27.53%, or that 27.53% comes out to $68.51. And you can tell by the fact that it's green that it's obviously been a bullish market, meaning the stock has gone up in its price. You got your Y variable over here just being the price of the stock, and X variable being time. It's pretty straightforward. Now getting into dividends. Dividends are what I like to think of as the side menu for your main meal. So obviously the stock and whatever you're investing, and hopefully that growth in your investment, is the main meal and the reason you came to the stock market. But in order to incentivize you to buy shares in their company, the board of any given company will determine what sorts of dividends they're willing to give out. That is based on how much of their company you currently own, how many shares you own. They will pay you rewards for choosing to be a loyal investor in their company. Those rewards can come in a couple different forms. So you got your cash dividends and your stock dividends, and then you got your stock repurchases, which are a little bit different. And I'll just give you a second to pause the screen and read through those. The way I like to think about dividends is it's like my mac and cheese, on the side of really, really good provolone sandwich. Obviously, I came for the sandwich, but the mac and cheese is a nice bonus, and the better it is, the more likely I am to come back. So now, when we dive into numbers, I know, once again, just like graphs, it can be at first intimidating to look at equations and math, but really, it shouldn't be. One of my tricks when I look at an equation, especially one that uses division, is I just replace the word divided by with the word per. So, for example, this is earnings per share. It tells you how much a company makes per its outstanding shares. And when I say how much a company makes, I mean that's net income minus preferred stock. Don't get caught up in that preferred stock word right now. Just think of the net income, which tells you how much money does this company make in a given period of time, and then relative or per how many outstanding shares it has. Now you use that earnings per share in what's called your PE ratio, and a PE ratio is what actually shows up on a stock quote page. PE ratio is simply your share price, so how much it costs to buy a share of that stock, per your earnings per share. So how profitable is the company relative to how much it costs to buy equity in the company. It's a good indicator that you can use when you're comparing it against other companies in the same industry. Now, one of the big red flags that you want to avoid in investing is thinking that you can use a singular financial indicator as a altruistic, unequivocal statement about the company's financial health. These individual numbers only give you tiny snippets of information relative to how the company's doing and how its stock will go on to perform. What you need is a holistic picture, and in order to gain a holistic picture, you need to be understanding lots and lots of other financial indicators and variables that go on in that company. Some of them are qualitative, some are quantitative. And as you begin to paint that holistic picture, you'll feel much more comfortable with your understanding of how a company stock is going to perform and what sort of order you should place on it. So volume is something we briefly discussed earlier. Diving into volume, it's just simply the amount of transactions of a security that occur within a given period of time. So for Microsoft on June 12, 2023, there was 24 million shares that were traded on that day specifically. So obviously Microsoft has high volume. What high volume is usually indicative of is that whatever your last price is, say I were to place a market order for a share of Microsoft October 4th, 1:03 and 18 seconds p.m., it's more likely, because of my high volume, that whatever my share price that my market order is actually executed at comes out very, very close to that $318.05. With securities that have low volume in their trading, there's typically a little bit bigger of a difference between what the last price is listed as and what your market order is actually executed as. Market cap just tells you how much money or how much value a company has on a stock market. And what I mean by that is it's simply whatever its current share price is multiplied by how many shares it has on the market. It just is it's an indicator of how big the company is. So large companies like Microsoft are going to have huge market caps. Smaller startups that maybe just recently had their IPOs, you're looking at smaller market caps. So these numbers that we're talking about also appear on the stock quote page when you Google Finance, and they come up in this box to the right. As you can see here, you've got your market cap for Microsoft at that 2.36 million, which is huge, like I said. Average volume for any day within this year is about 20.7 million, massive again. Your PE ratio, just telling you how much your shares are costing relative to how much money Microsoft is making per each outstanding share it has. Just a indicator of its financial health is right here. And there's some other numbers that if you want to take the time to Google and look them up, you can figure them out. This next part, diving into ROI and ROE. These are commonly thrown around terms that have a not really discrete but distinct difference, yet it seems that they're constantly overlooked and used synonymously. They're not. ROE represents investors. It stands for return on investment, and it evaluates how profitable your decisions to invest are. And ROE is used on the company side. It tells them when you put money into their company, how profitable are they relative to how much money you've invested in them. So for me, if you asked me for my ROE and you'd invested $10 into my company and I used that $10 to make 20, well, then I would have an ROE of 20 over 10, so $2 for every dollar you invest in me. Here's the equations for those. Next number that we'll look at is book value, and book value is a frequently misinterpreted indicator for a lot of novice investors who don't quite understand the intricacies of financial indicators, or especially debt. Debt is so frequently just utilized as a red flag for people. We want to stay away from debt at every single level of the economy, macro and micro. Realistically, debt can mean a lot of things for a new company just starting out. Their book value, which is their total assets minus their total liabilities, say it were happen to be negative, it could actually mean that the company has leveraged itself in such a manner that it knows that by taking on this debt, it's going to be able to turn massive profits in the near future, and it's very confident in what it's taking on debt for. On the inverse of that, you could have a company that's supporting its operations with its debt, and it's 30 years into doing what it's been doing. That, on the other hand, could be something that's indicative of a company that's just trying to stay alive. If they're not turning proper profits and they're not making new ventures and they're taking out debt on debt to cover their debt, which is a thing, by the way, then might be indicative of a bad company. But once again, holistic picture, you don't know the story until you have all the information you can obtain, and even then, you probably don't understand it perfectly. Profit margin, real simple. It's just telling you based on how much money you make, how much money do you actually make. What I mean by that is if I make $100, but it costs me $100 to make the $100, then my profit margin is 0%. It's that $100 minus $100 divided by that original $100. Typically, a good sign of a steadily and healthy growing company could be that they have a steady a profit margin that maybe even seems to be growing because their costs of goods sold are going down. If you've heard of economies of scale, maybe that's going on. They're becoming more efficient in how they produce their products. So yeah, once again, another number that you can use to determine, help determine whether or not the company is something you want to invest in.